Another live question came in from Chih, and I just want to spend a few minutes on this. And this is related to the married put discussion. Course, you know, the blueprint course that discusses the married put and all 12 different income methods that we use against that limited risk structure to reduce the initial at risk, potentially bulletproof the trade, and increase profits. The blueprint is written fairly simply, and it is designed for investors who started out with covered calls or other strategies, didn't meet their targets because the losses outpaced the gains, even covered calls. Cash secured naked puts. The structure of that trade works against you in various and volatile markets. Whereas in the proper protected position where we have this graph, we own stock and we own a put option in the proper structure that gives us a controlled risk. We can't lose more, no matter what happens, than let's say 4 to 7%, 4 to 8% on a position. And because we're buying stock, we're buying the put, we could simply sell calls against it to lower that initial at risk and bulletproof the trade. There's also 4 ways to manipulate the put option to have the same effect, to lower the initial at risk, lower the cost basis of the position, to have further profits to the upside, expecting a movement upwards after we've entered the trade and maybe there's been a pullback. Different adjustments. The put is not only protection, it is a second working asset in our favor due to the proper structure. Now, let's go into the search tool. The blueprint not only describes what we're looking for in the 12 different income methods, the blueprint also describes the stock structure and criteria that we want to use for the structure. And of all the criteria that are available in all the searches for the base option criteria, following the rules in the blueprint and the proper structure, we're looking to buy puts against our preferred stocks with other stock criteria involved, technicals and fundamentals. But stocks are at least 150 days out in time. The risk is between 3.5% to 9.5%. I usually change that to about 7.5% or 8% to meet my target goals. And we don't want to go more than 20% in the money. Now, why I'm going through this exercise is because Chih had asked, I'm just starting to learn the blueprint and go through the radioactive trading criteria. I'm getting the principles, but I feel there's something missing, I believe is the comment you used, Chih. You phrased this a little bit differently. But in the approach for the adjustments to limit risk in volatile markets, control the risk, and use the income methods, I don't see a lot of talk about delta or implied volatility in the blueprint for the structure or for when to apply the income methods. And the reason why is simply because we don't use them. But in a sense, we are using them. Now, what do I mean by that? Let's go into change columns, and I'm going to add the delta in. I had implied volatility in, but I want to move those up a little bit more. I'll even add the gamma, daily theta, vega, and rho, the other Greeks involved, even though we wouldn't pay attention really to rho so much or vega, but let's just do that because that's related to Chih's question. I want to change the column order though. I'm going to see these better on the screen. So first, let me take that implied volatility up and put it next to the, I'll put it in range out of the money. We'll do the delta the same, gamma, theta, vega, and rho, okay? All right. Now, the reason why I want to share this is because we just quickly reviewed the criteria that are available. I can screen by implied volatility in all strategies. I can screen by the % implied volatility range in all strategies. Implied volatility over stock volatility. I can screen by delta. Other strategies, I can also screen by other Greeks also. These are not filters that are used on the preferred search for the entry into the married put position. But if we take a look at just the delta column that I added, you see that in the preferred structures, we are in an extremely tight range of delta. Our lowest delta is 0.43. No, I'm sorry, it's 0.42. My apologies. 0.42 is what I have as the lowest. And the highest I think I saw was 0.55. At other times, the range might go from 0.55 to, this is just on the first page, but it might go from 0.55 up to, say, 0.68 or 0.65. Even though we're not using delta, the delta is in a very tight range. Because of the other criteria that we're using, they go hand in hand. You don't need to use the obscure terms. I don't want to say archaic, but obscure terms of delta, gamma, theta. It's already there. Implied volatility. Because of the proper structure and the stocks we prefer, looks like my highest is 0.6391. And the lowest I'm saying is that 0.3243. If I see another lower one, I'll let you know. But I think that's it. Same ones for the delta range we were looking at, which makes sense. That's a pretty tight implied volatility range. We could narrow it down further. But it's because if the implied volatility was too low, it probably wouldn't match the criteria for growth that we're looking for in the other stock technicals and fundamentals. And if the implied volatility was too high, the preferred structure of not going more than 15 or 20% in the money would have a risk outside of the range that we're looking for. The risk would be too high. So it's already filtered out. You are using implied volatility and delta. Gamma is the same, theta is the same. They're all going to be in a relative range, even though we're not using any of those filters. This relates to some other discussions that we have on YouTube. I just want to point those out real quick that you might want to consider looking at a later time. You go to the YouTube channel, go on our videos and do a search, and just look for Greeks. And the full presentation, if you don't know what I'm talking about, if you're just getting started in options, you don't know what I'm talking about with delta, gamma, theta, vega, this is an 8-year-old presentation. It's an hour and 30 minutes long, but it goes through each individual Greek, the definition, so forth, why and why you may not need them. But it goes through delta, gamma, theta, vega, rho, what they are, what it does, how it affects the option position, and so forth. But just a quick review, graph of the Greeks and why you may need them. We discuss certain strategies, why you don't need the Greeks really in those strategies we feel, and the strategies you probably definitely do need the Greeks to evaluate for things such as delta ratio, gamma ratio, and things of that nature. For standard covered call, cash secured naked put, using out of the money filters, using probability filters, using proper stock filters for the strategy, combined with proper structure, even for the married put, you don't need to use those filters. You're already using them without using them and get tied up in them, I should say. Now, let's talk about Chih's main point. And he talks about why I don't see a lot of discussion on the Greeks related to the income methods. What are the income methods? The income methods are adjustments that we use on positions to lower the initial at risk of the initial married put or generate income to also lower the risk. And the put option can be used as well. Let's go to the Annette position here. This is the current position in the Fusion portfolio. The stock purchase price of 120.47 made some adjustments up and down. Currently own the September 125 strike put, and the stock's at 133.27. Was as high as about 138.40 this week. I should have done income method number 4. I did not, but we're going to have some fun with that, and I'll show you that in a moment. So let's just go to the position analysis screen. As I'm tracking any position in the PowerOptions portfolio, we can link to position actions and position analysis. This will give us a breakdown of our current position. Yeah, max risk is 7.8%. Not a fan of that. I want to reduce that. And earnings date is 3 days away. I'm going to definitely reduce, if not bulletproof, this position prior to that earnings event. And here's your basic profit and loss chart. And I see, okay, I can sell a call here, and there's some variety of different calls to sell. But in the column heading, there's nothing that mentions implied volatility, delta, or anything along those lines. Why? Which is the best one to choose? Well, the best one to choose, as discussed in the blueprint, each income method has its own chapter. And in each chapter, we talk about the SIGA model for the income method, the decision-making process you'd use, current conditions, expectations, your goals, and that'll help determine your action. So what is my goals here for Annette? Well, I moved the put recently down in price and out in time to lower the cost basis of the position. I still have a controlled risk of 7.8%. I'm currently at a liquidation profit of 6.5% as the stock had recovered as I expected. I'll talk about that move in a moment. But earnings are coming up in 3 days. I want to reduce the risk, and I have this opportunity to do income method number 1. That's talked about in the free white paper, the sketch. I could just sell a call against it, generate some income, cut the risk in half. Let's say we cut it down to 3.1% by selling the March 10th 134 call for 655. That's 28 days out in time. I'd probably like to be closer, 14 days out in time, but let's take a look. As you see a rollout opportunity, you can compare the before and after position by going to simulate trade on that rollout opportunity. So I'm going from a married put position with a risk of 7.8%, current liquidation value of 6.5%, to a position that has a max return of 11.7 if Annette's right at 134 on March expiration, and I've cut the risk in half, more than in half, from 7.8 down to 3.1. But earnings are coming up in 3 days. Do I want to have a capped gain right at the money if maybe my expectation is this stock could jump 7 to 8%, maybe 10% with a positive earnings? Now, I want to leave that upside open. I want to take this risk down, but leave the upside open as well. Okay, so are there other opportunities that are available to do that? I could move the put in time. I could sell to close my put and move it closer in time via what's called income method number 3, to where I'd have a bulletproof position of 1.5, 1.8, 2.2% on the trade. At March 134 looks pretty good, or 2.5 at the March 135 strike. Going into earnings, guaranteed profit of 2.5%, even if the stock falls 10, 12, 20% or more, but leaving the upside open. What's not in the columns? Delta, Vega, Gamma, Rho, implied volatility. What I'm focused on is what are the adjustments doing to my at-risk to meet my goals for the position? Which position gives me the bulletproof status that I want going into the earnings event with the opportunity to still do income? Regardless of the delta, all of these are viable trades to use. They're in here based on the general rules in the blueprint. Of course, the full discussion of the SIGA model is only available in the blueprint position. I could even use income method number 4 and cut the risk. Yeah, just about in half there. Yeah, cut it in half there by moving up to the September 135 put option as well. So there's a lot of opportunities here to do some damage and do some proper adjustments without considering the current delta and the implied volatility. And of course, one of the other things I had to mention to Chih on that topic was that the implied volatility is not really a focus. As I mentioned in the search tool, if I was opening that position initially using the defined search, and 99% of the trades that Ernie and I post in the Fusion portfolio come right from this default search. That's our preferred ones we use. I have some other searches I like to use in different market conditions, but 95% of the ones I post in Fusion come directly from this search. And again, it is incorporating delta, implied volatility, gamma, and theta without even using them because of the proper structure. Again, in some strategies, Greeks and why you may not need them. Now, let's take a deeper look at Annette. And back on this January 23rd, my apologies, I made an adjustment. I moved the put down in price. I had the 130 put and the stock had fallen to about back to 120, back to 118. And I rolled the put down to 125, which lowered my initial cost basis into the entire position. But I am giving myself 5 points less guaranteed exit. But I did this because I thought the stock had hit a bottom at that time and was going to move back up in price, sort of as discussed in the blueprint. Now, I didn't do it at the peak time. Okay, you can kind of see, let me scroll down here on the chart here. Is January 23rd-ish. So I did it before the best time. The best time was the 24th or maybe the 25th. I did it here when the stock was around 118. And you can see why. I started to see this movement on the MACD. It started to move above the 20-day moving average from where it was. I was holding the 130 put this entire time. When I started to see the directional changes, that's when I took profits on the long put that I had, moved it out in time to give myself more time, and was able to take advantage of this movement up. At this point here, we were about an 8.7, 9.2 liquidation return. And this would have been the best time to move up the put. This is still a good time, but I'm going to do something different now. Not going to say I missed my window, Chih, but when I move down to the 125 put here, we're at the 125 strike. I selected the put strike when the stock was around, it was probably about 118, 117.50. Why I chose the 125 strike is because that was the put I would have used at the time on the 23rd of January. If I was going into Annette New, buying it at 117.50, looking for a put that was at least 150 to 200, 250 days out in time, less than 15% in the money, and gave me that controlled risk I wanted of 4 to 8% or so. And that was the 125 strike. See, if I based it just on delta, saying that if delta is ever, I started off with a delta, let's say, of 0.55. Well, if my delta goes to 0.65, I'm going to move it down to 0.55. And if that delta goes up to 0.65 or 0.7, it's in the money, I'm going to go back to 0.55. I would have adjusted the position here, then again here, then again here, and look to start moving it back up there. Each time, the effective income method number 9 would have taken place. Now, my opportunity to roll up the put to bulletproof here, as we saw with income method number 3, or close to it with income method number 4, again, if I was following a delta rule, I would have been over trading once again. I would have probably done IM number 4 here, then again here, each time increasing the debit slightly, although I would have been reducing my risk, but done at the right time. The risk reduction would have been better at this point rather than doing it in each stage. As I mentioned to Chih in the email I responded to him, trying to force income methods based on those subtle movements and trying to keep a similar delta from where you initially started, or trying to assign delta rules to it, means you're more likely over trading the position and you're not having the best benefit. We're going to expand on that more for blueprint owners in a different presentation to emphasize some of the more in-depth concepts that are already there in some senses for blueprint owners, but for the income method number 4, income method number 3, and income method number 9 as well. Chose 9 correctly. Hey, maybe it wasn't at the best time, but it worked out really well. Exactly as I wanted. Maybe missed out on income method number 4, but as we saw, still have that opportunity to bulletproof the trade with other income methods. And what I may look to do Monday or Tuesday, most likely Monday, and blueprint owners and Fusion subscribers will see a little bit fuller description on this. Excuse me. As we're probably going to move the Annette position to maybe something like this, having a 1% risk only going into earnings right at the money with a chance for profit. The stock moves down 10% or moves up 10% or 7 or 8%, not capping the upside. Or we might have some more fun with it and maybe do something along the lines here, applying an income method number 6. After that movement, oh, no, I want 1 and 1. Just 1 and 1. to have what looks like a no-risk long strangle, only a guaranteed profit of 0.3%, but there's a way to increase that to 3% actually using another adjustment, and that's what I'm going to evaluate. I'm going to get a little crazy with this one. I'll have some fun with Annette. I can still liquidate for the 6 or 7% profit. I can bulletproof it to 3% guaranteed return with infinite upside and large profit to the downside with some of those combinations of the put adjustments and the riskless spread trades that we talk about. Again, that's all discussed in the blueprint, the full course there, the 12 different income methods and beyond also. So Chih, that's sort of what my thoughts were there. We're going to touch upon that a little bit more about the over trading. Again, that's, of trying to force adjustments each time X or Y happens. You really want to apply that SIGA model that's discussed in each chapter of the blueprint for the income methods for the decision-making process that matches your goals.